Welcome to the Deep Dive. Today we are digging into the Q2 fiscal 2026 earnings call for Resource Connection, RGP.
Yep, the professional services firm.
And this one is a real head-scratcher at first glance. We've got this classic corporate contradiction playing out. The company showed, phenomenal discipline on cost control, but at the same time, that success was just completely and instantly overshadowed by a severe slowdown in demand.
It really was. And if you were watching the stock after hours, you saw the verdict. It was fast and it was harsh.
Exactly. So in this deep dive, that's what we're trying to figure out. Why was the good news, the profit beat, so completely ignored? We're going to unpack the numbers, dissect the new CEO's strategy, and get into what this AI threat really means for them.
And it is a puzzling picture. The initial data was just a mix of really conflicting signals. On the one hand, you had adjusted diluted earnings per share, so EPS, coming in at 6 cents.
6 cents. And analysts were expecting, what, a loss?
The loss of 2 cents. So that's a huge, an 8-cent beat on that adjusted number. A really significant beat.
Okay, so that's the good news. But here's the anchor, the part that dragged everything down. The revenue figure.
The revenue. It came in at $117.7 million.
Which missed expectations. Not by a ton, but it missed.
It missed the $119.3 million estimate, yeah. But the real story is the year-over-year number, a decline of 19.1%.
Wow. Almost a fifth of their revenue just gone compared to last year.
And that's it. That's the reason. The stock dropped nearly 12% after hours, just like that.
So despite the headline profit beat,
investors just couldn't look past that top line. For a company like this, a professional services firm, you're selling billable hours. Growth and demand, that's everything.
Right. If your revenue is shrinking that fast, it's a huge red flag. It means clients are pulling back on projects. It's not like a tech company cutting some R&D budget. This is your core product not being bought.
And management knew it. They didn't try to sugarcoat it. The new CEO, Roger Carlyle, was very direct on the call. He acknowledged the, and I'm quoting here, continued lack of positive momentum.
No kidding.
So if you look deeper at the financials, you can really see the pain. The drop from over $145 million last year down to $117. That just erodes your profitability.
So how bad did the margins get?
Adjusted EBITDA fell from $9.7 million a year ago to just $4 million this quarter. That left them with a margin of only 3.4%.
3.4. For a professional services firm, that is razor thin. You're dangerously close to not being able to hold on to your best people at that level.
Which makes the cost-cutting part of the story even more critical. This is where they showed real discipline. The reason they beat on that adjusted EPS number was because of surgical cost control.
Okay, so let's get into that. What did they actually do?
Two things really stand out. First, their pay-bill ratio. It improved by 97 basis points. It's now at 81%.
And for anyone listening, the pay-bill ratio is basically the cost of your consultant versus what you charge the client for them. Improving that is a really big deal.
It is. It suggests they're getting better utilization from their talent, or maybe just negotiating rates better.
But wait a second. How much of that is a real structural improvement and how much is just, lower variable compensation because they missed revenue targets and bonuses didn't pay out?
That's the million-dollar question, and the answer is probably a bit of both. But they did provide evidence of real structural cuts. The biggest piece of evidence is their SG&A expense.
Selling, general, and administrative.
Exactly. The run rate for that dropped 15% year over year, down to $39.7 million. That's a huge amount of savings.
And that came from where?
Directly from reductions in management compensation, and specifically from the reductions in force, the RIFs. They did in October and at the end of the last fiscal year. They're cutting headcount.
So they're definitely cutting bone, not just trimming a little fat here and there.
No, these are serious cuts. And we should probably mention one other thing that hit their margins this quarter. Management called it an anomaly.
It's an anomaly.
In their healthcare claims. Apparently, they had a big spike in October that had an unfavorable impact of over $1 million.
$1 million, just on a healthcare spike.
Yeah. They said if you normalize for that, their gross margin, which came in at 37.1%, would have actually been closer to 38%.
Okay, so it doesn't solve the demand problem, but it shows that 3.4% EBITDA margin was maybe even a little worse than it should have been.
Exactly.
Yeah.
So you've got these painful results, but you can see they have control of their costs. And that's all supported by their liquidity.
Which is pretty strong, right?
Very strong. $76.5 million in cash and only $10 million in debt. That cash is a huge advantage. It buys them a runway to do this whole restructuring without having to raise more capital.
And they're still paying a dividend and have a buyback program in place.
79 million left on that buyback, yeah. The board clearly thinks the stock is cheap.
Okay, so with all that financial pressure, the real question is what the new CEO, Roger Carlyle, is going to do about it. What's the plan?
He laid out what he called decisive actions, built around 3 pillars.
Okay.
Pillar 1, align the cost structure with revenue. We've seen that with the RAFs.
Yep.
Pillar 2, refocus their on-demand offerings. And Pillar 3, scale the high-value consulting side of the business.
Let's break down that first one, the cost structure.
So the October RAF hit 5% of their administrative headcount. That one action alone is projected to save them between $6 and $8 million a year, annually.
That's locked in.
Locked in.
Yeah.
And they're also doing a bigger 12-month review across the whole company, looking for more places to simplify and automate. So, more cuts could be coming.
So that fits with Pillar 3, scaling consulting. But how do you do both? I mean, how do you aggressively cut administrative staff while you're also trying to scale up a high-value consulting business? Are those two things sort of in conflict?
They can be.
Yeah.
But it shows they're making a very deliberate choice. They're cutting what they see as low-value overhead to free up money to invest in high-value talent.
And they're focused on specific areas for that talent.
Very specific. CFO advisory, digital transformation, data analytics, risk, and financial tech. They're basically saying, we don't need a huge army of generalists anymore. We need a small, expensive, very specialized A-team.
Okay, so let's look forward then, because this is all about future demand. The guidance for Q3 confirms things are still going to be tough.
Absolutely. The revenue outlook for Q3 is between 105 and 110 million.
Which is another step down sequentially.
It is, yeah. And management blamed seasonality for that. You've got Christmas and New Year's falling midweek, which messes with billable hours and holiday pay.
And margins will get squeezed too, right? Because payroll taxes reset in January.
Exactly. So gross margin is guided down to between 35 and 36% for Q3.
And we also need to be careful about the costs in Q3 because the official numbers might look worse than the underlying business.
That's a great point. The run rate SG&A is guided to 40 to 42 million, which is similar to Q2. But, and this is a big but, they specifically said that number excludes an extra 6 to 7 million in non-cash expenses.
For things like stock compensation and the restructuring charges.
Right. So for you listening, this means the official GAAP bottom line will still show some pretty significant losses, even while the actual operational spending is coming down.
The real benefit of the cuts won't show up for another quarter or two, which, just fuels that market skepticism.
Precisely. They're taking the pain now, and the accounting reflects it, and the segment data confirms the slowdown. Consulting revenue down almost 29%, on demand down 18%.
So it's broad-based weakness?
Pretty much. The only small bright spots were in Europe Asia Pac and their smaller outsourced services segment.
Okay, this brings us to what I think is the heart of the whole story, the thing that was buried in the Q&A section of the call, the interception of AI, automation, and demand for their services.
This was fascinating.
They were asked directly which roles are being impacted by AI, and they confirmed it. Transactional, repeatable tasks. They specifically said operational accounting roles. Those are the jobs most at risk of being automated away.
And that is a huge confirmation. If that foundational accounting work is being automated, that's a core piece of the historical on-demand business for a firm like RGP.
But there's a flip side. AI displaces those jobs, but it creates a need for new, higher-level work.
Right. You need consultants to help clean up the data, implement the ERP systems, manage the change.
All the transformation initiatives.
Exactly. And the key takeaway here is skill evolution. It's not just replacement. For the higher level roles like controllers or senior financial analysts, it's about becoming AI experts or AI knowledgeable in your own function. The whole value chain is shifting upwards.
And how are clients reacting? Are they all jumping on board?
Not quite yet. Management said clients are sort of confused right now. They're wrestling with whether they should buy a bunch of spot technologies or just leverage the AI that's being built into their big existing platforms, like their ERP systems.
So that creates some hesitation.
It creates deliberation, but they said it's not leading to broad project delays, which is a good sign for future work.
So let's zoom out again. Investor context. Given everything we've talked about, RGP is now trading like a classic turnaround with optionality.
That's a perfect way to put it. The market is basically saying, We don't believe in the revenue story, so we're going to ignore your cost cuts for now. There's just no visibility on when demand will bottom out.
So what are the catalysts? What do investors need to see to change their minds?
Two things. First, the Q3 results have to show revenue stabilizing in that guided range. If they miss that 105 million floor, look out below.
And second,
they need to show that all this restructuring is actually working. They have to prove it's improving their underlying operating leverage, pushing that adjusted EBITDA margin way up from that ugly 3.4% we saw this quarter.
All right. It is now time for the segment we call This Is Not Financial Advice. We're putting on our cynical hedge fund analyst hats and pitching an outrageous but plausible trade idea.
Let's hear it.
Today's pitch is called the Deep Value Restructuring Bet. The trade is simple. Go long RGP. The thesis is that the 11.8% after-hours drop is an irrational fear floor. This trade completely ignores the weak Q3 revenue outlook. You don't care about it. You are betting solely on two things: the guaranteed cost cuts and capital allocation.
So you're betting on the math.
Purely the math. RGP is swimming in cash, $76.5 million. They have a guaranteed $6 to $8 million in annual SG&A savings coming from the RIF. Our bet is that management, feeling the pressure, uses that cash to get aggressive with their $79 million share buyback program, especially at these depressed prices.
So accelerated buybacks plus locked-in cost savings.
You got it. That combination dramatically boosts EPS on a smaller share count, which creates a hard valuation floor. It is a pure bet on CFO discipline winning out over CEO-level demand uncertainty, and you're betting the stock snaps back when profitability accelerates faster than the street is expecting.
An interesting bet on financial engineering.
So, to recap the whole story from this deep dive, RGP is hitting the reset button. It's a necessary financial reset. They are choosing disciplined cost structure over chasing growth in a really choppy AI-driven environment. They're right-sizing the ship before they try to turn it.
A painful but probably necessary move.
And that leads to the really interesting long-term question, the provocative thought to leave you with. Management confirmed that AI is creating a need for a small pool of extremely expensive, highly specialized AI-savvy consultants. These are the people who will drive their new strategy. So the question is this: will the high cost of acquiring and retaining that elite talent eventually erode, or maybe even completely wipe out the efficiency gains they're making right now through all this aggressive cost cutting?
That is the strategic tightrope they have to walk.
Thank you for joining us for this deep dive.